Good day everybody and welcome to our latest webinar. My name is Bruce and today I'm going to take you through the requirements in IAS 38 relating to the accounting for intangible assets. Now, intangible assets are an interesting part of IFRS. If we go back many years, intangibles weren't such a big thing. It wasn't something people saw a lot of. It wasn't something that came across unless you bought a major brand or a major trademark. But since the advent of the internet, we've obviously seen a huge growth in intangible assets. All those things coming out of the online world, a lot of new brands, a lot of this, a different way of looking at marketing. So the whole accounting for intangibles has obviously risen a lot since all of this is taken into account. Now, brands have a big impact on finance at the moment. I mean, just interestingly, this is a graphic somebody sent me the other day, just showing the different major companies around the world and all the huge global brands that they control. And if you consider that each of these brands has got value, and if you went and bought any of these companies, you potentially have to value or account for these, you can see how this can quite substantially impact the balance sheet of any company. So the accounting for intangible assets is something that has become quite a focal point for many years. Now, the starting point when we take a look at intangible assets is to ask ourselves, what exactly is an intangible asset? Well, intangible assets is defined as any asset that is an identifiable non-monetary asset without physical substance. Now, a couple of things are that definition that are important to understand as we get into the accounting. Firstly, of course, we're saying it has to be a non-monetary asset. That's easy, but it's without physical substance. And that, I think, is the key differentiating feature clearly between your fixed assets and these. Now, whereas the accounting for fixed assets and intangibles at a very high level is quite similar, there are some very unique requirements in IAS 38 that require you to look at these slightly differently because of that fact that they are assets without physical substance. And the starting point is that they require that there are two key characteristics that you have to be able to demonstrate in order to show that you have an intangible asset. And those are, firstly, that it is identifiable, and secondly, that it meets the definition of an asset. Now let's take a look at each of these in turn. The first one says that the asset needs to be identifiable. Now what that means effectively is that you've got to be able to identify it separately from anything else. Now they say that something is identifiable when it's either separable or it arises from a legal or some sort of other right. Let's take a look at those. The first one says that an intangible asset has to be separable. In other words, it has to be capable of being separated or divided from the entity. So I've got to have something that I can sell, I can transfer, I can license to somebody else. Whatever it's going to be, it's got to be something that at the end of the day can be separated from the company itself. Now, of course, sometimes that needs to be with a related asset, but it's got to be something that I could point to identify. So a simple example, let's assume I have two footballs, both of them made in the identical factory. They weigh the same amount of leather, almost identical. The one is worth, say, $100 because you can go and buy it at any corner shop, and the other one is worth $5,000. Well, why is the one worth more than the other? Well, simply the one that's worth $5,000 was the one that was used in the Football World Cup final and scored the winning goal. Now, if I take a look at these two balls, from a physical point of view, they're identical. Both footballs, same weight as I mentioned. But we know, we can identify that there's clearly an intangible asset related to the second one, as that is the one that was used in the football, giving it that value. Now, that is separable. Why? Because I can take the value of that and I can transfer it from me to you. In other words, I can sell the football to you. Yes, of course, that has to be transferred with the accompanying football. I can't separate the football from the intangible. And that's fine. The standard accepts that there can be an intangible related to something where it's attached to an asset. But very importantly, I'd have to be able to sell that from me to you. I can transfer it to you. So I can clearly identify what is the intangible related to that. The second one it says, and I think that's probably the slightly easier one for any of us to identify with, and that is the one that talks about contractual or other legal rights. And in this situation, we're saying it's something that arises, for example, if I write a textbook on IFRS and I say I'm going to license that out to you, and you will have the ability to sell that textbook. Well, clearly I've given you the license for it. I've given you the legal right to go out and sell that. You can then print them off and sell them, or music rights, or whatever it's going to be. So I think sometimes it's a bit easier to obviously show something's legal or contractual because I've transferred a right to you, whereas sometimes the separable can be a little bit trickier. Now that's the first part of the definition, and as I said, you've got to be able to show that somewhere along the line it's separable. The second thing, of course, says that it needs to meet the definition of an asset, and an asset is defined in the framework as any resource controlled by an entity as a result of a past event from which future economic benefits are expected to flow. That's our standard asset definition. And that pretty much flows through to all the assets you'll see under IFRS. So very much we're saying providing it meets this standard definition plus the additional requirements we spoke about in the previous slide, then you have an intangible asset. Now, once you've got the intangible asset, or you've got something you believe is an intangible asset, how exactly do you recognize it? Now, recognizing an intangible asset on day one is no different really to any of the other assets, and the general principle is that you would recognize these at cost. But of course, that can differ because there are different ways in which you can get an intangible asset onto your balance sheet. So what I want to do is I want to do a little exercise. I want you to think, how do you get intangible assets onto your balance sheet? Now, I'm going to give you 30 seconds, and I want you to write down. I'll give you a subtle clue. There are 5 ways. I want you effectively to write down what are the 5 ways in which you can get an intangible asset onto your balance sheet. Take 30 seconds and write it down. Okay, so anybody who's just joined us, all I'm asking you to do is say, I'm giving you 30 seconds to write down what are the 5 ways in which you get an intangible asset onto your balance sheet. Right, now that we've stretched your minds a bit to start off with the webinar, I want to go through the 5 ways that you can get these. The first way you can get something onto your balance sheet is the simple way, through separate acquisition. I go out and I choose to buy an intangible asset. The second one is government grant, where the government effectively gives me an intangible asset through a grant. We'll talk about each of these separately. The third one, an exchange of assets. And an exchange of assets, effectively, we're saying I exchange. I give you something, you give me an intangible asset. So we're having an exchange transaction and I'm receiving an intangible. As the receive side of that. Number 4, internally generated, and we'll see now that there's some restrictions on that. And the fifth one, business combination. Now, what's interesting about that is that there are 5 ways, and not many of you would have come across all 5 of those. But the one that recently, in the last number of years, has really been resulting in a huge number of intangible assets is that number 5 on business combinations. And so we'll spend just a little bit of time looking at those later. Now, let's go through how you'd recognize each of these on day one. The first one is where you have separate acquisition, and this is probably the easiest one to understand. I go out and I buy as I mentioned earlier, a license for something, an intangible, a brand, whatever it's going to be. I buy something from a third party. Well, the fact that I'm purchasing this from a third party means effectively I can assume that benefits will flow to me. Why? Well, in a normal arm's length transaction, we've agreed a price, I've purchased something from you, I can tick that box instantly because we're saying the fact that I paid for something from a third party and I'm receiving the intangible must mean that I believe that I'm going to get benefits. Otherwise, why would I have bought it? So when I recognize it on day one, the standard says I would recognize it at cost, so whatever I paid for that intangible asset. And of course, I can capitalize any of those costs that you'd normally be associated with a purchase. So the purchase price itself plus any import duties or taxes that may be there. And then, of course, I'm allowed to capitalize any of the directly attributable costs. Now, remember, the simple definition of directly attributable costs is any costs that you would have avoided had you not purchased the intangible asset. So what we're really saying here is I'm talking about things like legal fees, stamp duties, anything that may have directly been involved in the acquisition of the intangible. Those can be capitalized to it. Of course, remember that if you have got a deferred payment, so if I'm paying you off over 3 years, interest-free, for example, well, then clearly I would need to apply discounting to that and present value the purchase price and the costs, and obviously account for that using an effective interest rate. So yeah, discounting would apply if there's a deferred payment. So that's the first one, separate acquisition, quite easy. The second one is an interesting one, and that's the one that says you can receive an intangible asset through a government grant. So government chooses to give me something, assume it's a mobile 3G license or 5G license as they're now talking about, or it could be some sort of intangible. Whatever it is, government can choose to give me something. Now, when you look at government grant accounting, it says effectively, remember, you can get something either for free or at a nominal amount. If you're purchasing something from government at a fair value, well, then clearly it's not a government grant because you're not receiving any benefit. But we're assuming here that in this situation, I've received something for free or at a nominal value. In accounting for that, ICE 38 defers to ICE 20 and says you need to apply on initial recognition the accounting that applies in ICE 20. And ICE 20 says that I can account for a government grant either at fair value or at a nominal amount plus any directly attributable costs. Now this is very strange accounting, and unfortunately with an intangible you are subject to the ICE 20 government grant accounting. And the reason I say it's strange is assume that the government came and gave me the 5G license for a country. Well, a 5G mobile data license will probably be worth $100 million, if not more. I can choose to account for something. So they give me a $100 million license, and all I have to pay is $10 for license fees for stamp duty. I could, in that situation, elect to account for the intangible asset either at $100 million, or I could account for it the $10 being just the stamp duty. Now, quite strange, isn't it, that the standards are giving us the option to choose to account for something at $100 million or $10. Now, why are they giving you that choice? Well, that goes back, as I said, to the accounting in ICE 20. So at this stage, until the ISB decides to change that, we are stuck with that choice. What do people do in practice? Completely depends on their approach. And what I mean by that is it depends on whether you're an income-driven approach or you've got a balance sheet-driven approach. If, of course, you're a company and you're very much driven by your balance sheet and the shareholders see value in your balance sheet, well, then you'd probably go the fair value approach because now you've got a $100 million asset that you could put onto balance sheet. Of course, the negative on that is that you'd now have to amortize that, which is going to have a negative impact on your earnings as the amortization goes through P&L. On the other side, if I'm very earnings-driven, well, I'm going to go the $10 route. Yes, I'll have next to nothing or probably lost in the rounding on my balance sheets. I have nothing on my balance sheet, but I'm avoiding the amortization charge in my income statement. So I guess it very much depends on whether you or your clients are more income statement driven or balance sheet driven. And as I said, this is a free choice that you've got. Right, moving on. The third way in which we can get an intangible asset onto our balance sheet is through the exchange of assets. So this is a situation where we enter into a non-cash transaction where I give you something. For example, I give you advisory services and you pay me with an intangible asset. So if I came and say I was going to deliver 10 days of training in your office, and for that you will give me the right to be able to say some sort of intangible, a software product that you have. I get the right to use the software for 5 years or whatever it may be. I would have to say, well, how do I account for that intangible asset? Remember, just because it's non-cash doesn't mean there is no transaction. So as I'm saying, providing you have a transaction that has commercial substance, I would have to account for the intangible asset that I receive at fair value. So once again, I'm giving you advisory services, you're giving me an intangible asset, being some software. I would have to say, what is the fair value of that software I'm receiving? And I'd take that fair value and I'd account for the asset at that value. If, of course, I couldn't fair value the software, so for whatever reason you were giving me something for which I can't get a fair value, then what I'd do is I'd have to fair value effectively what am I giving up to you. So I'd say, well, what is the normal value of the 10 days of services I'm giving to you? And I'd take that fair value, and that would become the surrogate for the fair value of the intangible asset. You'll note there, of course, that I did say that I would have to, we would use commercial substance. Very importantly, remember, in exchange transactions, they say you should always have some sort of commercial substance between it. What commercial substance means, remember, is that is simply that the transaction makes sense from a commercial point of view. So you wouldn't have a situation where I went and delivered 1 day of training for you and you decide to give me a brand new Ferrari. If you would like to do that, I'll happily come and do the training in your offices at any time you want. But the reality is most people would say, well, hang on, a Ferrari is worth a huge amount of money versus the 1 day of training that you could get. As much as I may believe it's worth that value, the reality is I doubt commercially we can prove that. So very much you'd say, does the transaction have commercial substance? Remember, the only time we see transactions that generally don't have commercial substance are either intercompany transactions, where subsidiaries may trade on non-commercial terms with each other, simply because that's just the way the group is structured. And the other one, of course, is where government, and we've dealt with government grants earlier, government could choose to give you something for free, which has value, and people would say, well, why would they do that? Well, that's government. Maybe it's promoting jobs, whatever the situation may be, but they're trying to encourage trade. Very importantly, those could lack commercial substance. So number 3, effectively, we use the fair value. Number 4 is a strange one, because number 4 says to us that you have to recognize certain internally generated intangibles. But the starting point is almost the opposite to that. And the starting point very simply says that you may not recognize any internally generated intangible assets. So what we're effectively saying is my own brand, my customer lists, my titles, whatever I've got that has been internally generated, I cannot recognize on my own balance sheet. So for example, if you went and looked at Coca-Cola or Nike or Pepsi or McDonald's or any of the big global brands, you generally will not see that brand on balance sheet because that's their own internal brand. Now, I want to heavily point this out because we get a huge number of people who say to us, well, we're wanting to show the value of our own brand. Is there any way we can get it on balance sheet? And we've had some fantastic structures put to us where people are trying to sell and buy and do this. The reality is generally you cannot put your own brand on balance sheet. So unless you're going to enter into some very complex transactions, which will probably cost you a lot of money to try and get that onto balance sheet where you're selling it and buying it, etc., you're not going to get them on balance sheet. The other one, of course, that's prohibited at the top of the slide there, your internally generated goodwill. We may not recognize internally generated goodwill. So if all I've done is said you can't recognize any of these, well, why then do we get to a situation where I say that this is the fourth way you can get them? Simply because there is one way to get these on, and that is through research and development. The only time you're allowed to recognize your own intangible assets is when you're carrying out a program of research and development. Now, let me explain how this works. To start off with, a lot of people think that when you've got research and development, you've got a choice with the accounting. That is incorrect. With R&D, there is no choice in terms of how you do the accounting. The accounting is as is listed there. The principle is any research you carry out has to be expensed. Whereas any development you're carrying out, you have to capitalize the development expenditure. That is not an accounting policy choice. That is a requirement. Why is it some people see it as a choice? Well, because the line between when you're going from research to development, that's quite judgmental. And we see some companies who turn around and say, I don't necessarily want to recognize a whole lot of development assets. They push out this line quite late. Whereas if you do want to recognize it, some people try and move it earlier. So what is the line between R&D? The standard gives us a whole lot of requirements and says that when you're moving from research and development, you need to demonstrate that you've met all of the following in order to start capitalizing the development expenditure. And just to run through these for you, the first one says you need to show that the project you're undertaking or the asset that you're developing is technically feasible. So it's something that can be achieved. In other words, that there's something that you can show somewhere along the line. This is something that is not completely beyond the realms of anything that could be achieved. Secondly, that you've got an intention to complete the intangible asset and use or sell it. So we're showing very clearly that the board has approved it. We've got the intention to complete this project, to see the project through, and that we will use or sell the asset at the end of its life, or at the end of the development process. Thirdly, we've got to show the ability to use or sell the intangible assets. Somewhere along the line, we believe that there is a market for it, if it's something we are putting out there to sell, or if it is something we're developing to use within our business, that there is actually the need for it and something we can get value from that. To take it that step further, the fourth one says you have to be able to demonstrate how the intangible asset will generate future economic benefits. Remember that key definition we spoke about up front? Said in order to recognize an asset, you've got to show that there is a probable inflow of benefits. They've stretched that into here to say, I need to know somewhere along the line that there is going to be a benefit for me, whether that's a market for it, whether that's a benefit, a synergy or usefulness within the business, but something that you can demonstrate that this is going to generate benefits for us going forward. Number 5, that we have enough technical, financial, and other resources available to finish the project. So if we know that we need $2 million or 5 million euros, whatever the amount may be to finish the project, that's been made available to us. Secondly, there's enough technical skills around, so we've got the right people in the project to do that. And if there are any other resources we've got, that those are available to us in order to complete this. And lastly, that there is the ability to reliably measure the expenditure attributable to the project. Quite simple. How do we capitalize if we can't recognize what are the costs directly associated with it? Now this leads into what I was saying earlier, very importantly, that this is where it's a bit blurred, where some people say, well, we're never going to reach those, and we're going to push it very much out towards the end, so that by the time we get to capitalization, it's immaterial, in which case they effectively, in practice, end up expensing everything. Or some people could try very early to show that they've met all these criteria so that they can start capitalizing. This is very judgmental, and there's no rule, there's no requirement, so you're going to have to apply judgment in terms of how you do that. The only thing I will tell you in practice is where we've seen challenges is I had a client who was continually doing R&D projects, but they were never capitalizing anything. They kept pushing it out to the very end, very end, very end. Now, some of these projects were quite large. And one of the recent ones they did had a 20 million euro budget attached to it. And the challenge we put out there is we said, guys, this is the 5th project you're undertaking, and you're saying that you don't meet these requirements until the very end. But then challenged them on it and said, but hang on, guys, are you telling me the board's happy to spend 20 million before you can show that this is technically feasible, there's a market for it, there's a need for it, that you've got the resources to finish it? And when you think about it, when you start applying these, in practice, many people in management would want you to show these relatively early on. So if you've got a 20 million euro budget, they'd probably say, look, you've spent 3 or 4 million euros. By this stage, we would hope that you'd be able to demonstrate these. I'd be very surprised if somebody would say, we're happy to spend 15 million of a 20 million euro budget without knowing that these requirements have been met. I mean, they're pretty straightforward. So I would challenge if people aren't recognizing development expenditure to say, I think you do need to meet these. I would believe a bit earlier on than later. So now that you know you're going to capitalize the costs, what exactly can we capitalize? Well, quite simply, I've listed those there. Firstly, the expenditures on the materials or services you've used in generating the intangible asset. You can capitalize your salaries or wages of personnel, but remember, those are only the ones directly engaged on generating that asset. You can't do things like the security guard or the admin people or the PA at the front desk. We're talking about the directly attributable costs here. Thirdly, remember that this could meet the definition of a qualifying asset. Remember, qualifying asset defined under IAS 23 is any asset that takes a substantial period of time to get ready. So if you have got a qualifying asset, you would be required to capitalize any borrowing costs on that under IAS 23. And lastly, once again, the general catch-all, any directly attributable expenditure. So these are the things we'd include. Just to point out some of the things you would exclude, as I mentioned, your general overheads you would exclude from that. Any identified inefficiencies and initial operating losses. So if you know that in a startup there's an inefficiency in utilizing that, or there's some losses that are going to be incurred as you're integrating the intangible into your business process or whatever it may be, you can't capitalize those losses. So those would all have to be expensed as and when. And the last one, remember, of course, very importantly, staff training. Staff training cannot be capitalized. It's not deemed to be a resource that you control, therefore we would not allow you to put that in. So very importantly, just some of the examples of things we would exclude. The last of the 5 ways that you can get an intangible asset onto your balance sheet deals with business combinations. Now this, as I mentioned earlier, has probably become one of the most common ways to get intangible assets onto your balance sheet, because there was a recent amendment in 2009 to IFRS 3 and business combinations that kind of made intangibles the real spotlight of a business combination. And I'll explain what they did. Well, if you go back prior to the amendment to IFRS 3, what effectively the standard used to say is it used to say we would, as the graphic shows, we would have to go out and do a fair value exercise. And under IFRS 3, you'd fair value all the assets, you'd fair value all the liabilities, and then you'd say, what have we paid? And the difference between what we paid and what we're receiving effectively went to goodwill. And these goodwill figures could be quite large, and in most cases were, and still are. Problem is, somebody at the ISB woke up and said, look, we don't like this concept of goodwill. If you look at goodwill, it's just a blob on your consolidated balance sheet. It's a balancing figure, and I have yet to meet any investor, analyst, or anybody, a user of financial statements who actually sees value in goodwill. So the reality is it's just this big blob that's sitting there. They said, but surely there must be some reason for it. I mean, if I came and fair valued your business, and your business fair values at £50 million, and I pay you £80 million, why would I pay £30 million more? Well, either I'm a really nice guy, but for £30 million, I'm probably not that nice a guy. Or the reason is I know that I'm buying something else. And whereas in the past we've said, well, it must just be goodwill. The ISB's now said, no, there must be more to it. There must be a way you got to that value. Now, it can't be assets because we've already identified those and fair valued those, which means the only thing that could be left there must be intangible assets. This is where they made the amendment. And they now said, we must be able to identify the intangible assets that make that up. Now, there's a reason those intangible assets haven't been recognized in the past. And that is because under the requirements we've discussed earlier in IAS 38 to recognize an intangible asset, these were sometimes difficult to recognize in a business combination. This slide kind of summarizes all the requirements in intangible assets that need to be met. So we need to show, firstly, it's a resource controlled by the entity from which you'll get benefits. Well, that's easy. It's a resource controlled, yes. How do I know that? I've bought it from you, so I control your company if I buy you as a subsidiary. Secondly, do I think I'm going to get benefits? Well, once again, yes, we can assume that because I'm buying it from a third party, I'm paying you an additional amount, I must believe I'm going to get value. Secondly, without physical substance, tick that box. We're talking about intangibles. Thirdly, are they identifiable? And we went through that discussion on separable or legal contracts or contractual rights. So you'd go through those, and those are quite easy. And then we get to the last two. And the last two were the ones where people have always thrown problems. The very bottom one is the one I'm going to start with. It says, can we fair value the asset? Well, I'll tell you an interesting situation. I was doing a presentation at IFRS 3 when the standard first came out with a valuation expert from a large firm. And I'll never forget the valuation expert giving a simple rule. He said, I'll make you a deal. He says, whatever the intangible is, he says, you pay us enough money, we'll find a way to fair value it. And interestingly, that's actually what's happened in practice. There's a whole profession almost that's developed around purchase price allocations, doing these fair values. So the reality is you can always get a fair value for something. Which means the one that was really creating a problem was the second to last one. And that is that you had to show that it's probable that future economic benefits will flow to the entity. Now that, of course, is a bit of a challenge because when it comes to intangible assets in a business combination, remember the type of thing I'm talking about is if I come and buy your business, it's your brand. How can I show that it's probable that your brand will generate benefit for me? And that's tricky. And this is the reason why most intangible assets haven't been recognized, because we've said it's very difficult sometimes to show it's probable. So the ISB went away and they looked at this and they tried to find a technical resolution and they did a whole lot of research on it anyhow. And needless to say, they came up with one simple answer. They cheated. What I mean by cheated is they came out with a presumption. And all they said is, in a business combination, you can presume that you will receive future economic benefits from any intangible assets. Now that's quite an interesting concept. So instead of me having to prove to you that it's probable that I'll get benefits, we're saying I can presume that I am going to get benefits. Now once you presume you're going to get benefits, well effectively you almost end up recognizing anything as an intangible. Let's take a look at an example. Global Capital acquires a world-renowned Stellenbosch vineyard and winery. Interestingly, for those of you who don't know where Stellenbosch is, it's the wine-producing area in the Cape in South Africa. In determining the purchase price, Global Capital takes into account the following items that are not tangible assets: the skills and experience of a winemaker, the brand name attached to the wines, a special bottling technique, and a supply agreement with a popular chain of restaurants. What I want to do is I'm going to give you once again 30 seconds to think. I want you to tell me which of these would you recognize as separate intangible assets if you were doing the accounting for this business combination. I'll give you 30 seconds. Right, so all I'm asking you is which of those four items would you recognize as an intangible in the business combination we have here? Okay, so let's take a look at these. The first one says the skills and experience of a winemaker. Now, would you recognize that as an intangible asset? The answer is no. We never recognize the skills and experience of a winemaker. Now, what if they were under contract? So let's assume that this winemaker had a 5-year contract. They had to arrive at work. They had to do this. We would still not recognize this as an intangible asset. Why? Because it can never meet the definition. And the reason being, the definition says any intangible asset has to be a resource controlled by the entity. What's the problem here? The problem here is this is a person. And can you control people? Well, contrary to what your boss may tell you, no. You can never control people. Even if this winemaker is under contract and wants to be there and decides to come in every day, the reality is, the key thing about this is that if they don't want to be at work, you're not going to want to drink the wine they're going to make. So very importantly, you can never control people. So wherever we have situations of people, or what we call assembled workforces, so groups of people, etc., if you buy a company with a whole lot of people, you can never value those people as an intangible. Those always end up in goodwill. As for the others, the brand name attached to the vineyard, absolutely. The bottling technique, definitely. The supply agreement with a popular chain of restaurants, yes. All of these are examples of the type of intangible assets you end up recognizing in a business combination, which effectively means you can recognize almost anything. Now, when the standard first came out and the exposures, people were saying, well, what do you mean? What type of intangibles? So what the ISP did is to clarify it, they actually gave us a whole lot of examples. The types of examples they gave us are these. To start off with, your market-related intangibles, trademarks, trade names, your internet domain name, trade dress, what color, logos, brands, etc., newspaper mastheads if you got those, even non-competitive agreements. Okay, all of these had to be valued. The other ones they gave, some of them were quite easy to understand. Your artistic ones, plays, music, book, pictures, videos, we're happy with those. Licensing agreements, royalty agreements, favorable lease agreements. That's an interesting one. I buy a company who's currently paying 20 euros per square meter for their office. The market rate in that area is 35 euros per square meter. Well, they've got a favorable lease to the tune of 15 euros per square meter. So what we'd have to do is value that as an intangible in the business combination. So you can see there's a whole lot of things that start kicking in. Your franchises, your broadcast rights, air rights, etc. They then also give us what we call the customer-related ones. And these are the ones that have been quite controversial. Customer lists. So your customer list would have value. Order backlogs. Customer relationships. Non-contractual customer relationships. Now there's a strange one. If I'm in the UK, why would I go and shop at Asda and not at Sainsbury's? Well, why would I? Maybe it's just convenient for me. Maybe it's a loyalty. Whatever it may be. Key thing to point out is I have a non-contractual customer relationship with both those companies. Yet the fact is people would regularly go to one. That has value. So if I went and bought a Sainsbury's or bought an Asda, I would say, what is the value of those non-contractual customer relationships? And then, of course, as I mentioned earlier, the advent of the internet, all those technology ones. Patented technology, computer software, works, unpatented technologies, databases, trade secrets, you name it. All these type of things come in. Now, this is not an exhaustive list. I mean, these are just examples of the type of intangibles that you potentially have to recognize. But I do think it's important you understand that there are a lot more intangibles than there were many years ago. And that's why I said to you, business combinations is resulting in a lot of intangibles. All I just want to point out to end off this point is the exercise that you need to do is what we call a PPA, a purchase price allocation. And when you have a business combination, a major part of that purchase price allocation these days has been allocating values not just to the fixed assets, which is easier, but especially to things like the intangibles. In most situations, if you are doing a major business combination, I'd be very surprised if you don't need to consult with a specialist within your firm or within your company who can come out and do those valuations for you. Very few people I know can actually properly do those PPAs. So just be conscious that if you are advising somebody in a business combination, this is generally a bit of a time-consuming and can be a costly exercise to do. So bear it in mind. Okay, so where are we so far in our journey? Well, we've been through the initial accounting. So we've looked at the definition of an intangible asset. And as we've pointed out, there are 5 ways you can get an intangible onto your balance sheet, being the separate acquisition, the government grant, the exchange of assets, your research and development activities, and business combinations. Right, now you've got all these intangibles on your balance sheet and you've recognized them all at whatever way you got them on. How do we account for it thereafter? The accounting under IAS 38 is not very different to that under IAS 16 and property, plant and equipment. And that is that effectively the standard gives you the option to account for your intangible assets at either cost or effectively using a revaluation method. There's only one catch between the two, and that is that whereas you've got the choice of cost and revaluation if you read IAS 38, effectively the revaluation is never used. Now why is that? Under IAS 16 on property, plant and equipment, in order to do a revaluation, all you have to be able to do is get a fair value for the asset, and then you can do a revalue from there. Whereas under ICE 38, the standard says in order to do a revaluation, you can only revalue an intangible asset where you can show that there's an active market in those intangibles. Let me repeat that. You can only do a revaluation of an intangible when there is an active market in those intangibles. What do we mean by an active market? I mean that effectively I could take that intangible asset and go out into the market and at any point find similar products that are available freely in the market and can get a fair value. Now, I'm sure many of you are thinking, well, I can't think of any examples of that. And if you can't, you'd be right. These are very, very rare. The only two I've ever come across were fishing quotas in certain countries and taxi licenses in two of them Far East countries that I know. Other than that, we do not see intangible assets being revalued. So if you are planning on revaluing an intangible asset, you generally won't get it. So please, yeah, as I said, I would almost take it as a rule that you cannot revalue them. On a very exceptional basis, you can fair value. But as I said, the hurdle is very high in terms of having to show that. On the flip side of that, though, it's actually quite good news because that means that the accounting effectively is only cost, which means on day one, we effectively account for them at the cost, being the cost or the fair value as you've determined. Once you've got that value, that is what you then use for your accounting. But this, of course, is where the accounting, once again, differs a bit to fixed assets. The reason it differs is because for intangible assets, they require you to split them between what they call finite life and indefinite life intangible assets. Now, what do we mean by the difference between these two? Finite life intangible assets are those in which we have a life. So I buy a license for 5 years to produce a textbook. That means effectively I have a 5-year license, and I know the finite life for that. The same way, if I buy your business, I could say, well, your customer list, I believe, has only got a 3-year lifespan. Not that I would never deal with those customers, but I believe after 3 years, I'm really replacing it with my own internally generated customer list. So I believe the value of yours is 3 years, or the value of a brand I buy may only be 10 years. So really, those are things that we can attribute a life to. But what about those where you can't? So an example could be, I go out tomorrow and I buy Apple, the computers. I buy Apple tomorrow, the company. If I went and bought Apple tomorrow, how long do I think the Apple brand will last? Well, I have no idea. And I'm sure many of you out there don't. At the moment, I don't believe you could put a life on it. Somebody may arbitrarily say 50 years or 20 years or 100 years, but we don't know. So where you've got a life that you cannot determine, we determine those to be indefinite life intangibles. Whereas when you can determine a life, it's finite life. And we'll talk about the accounting for these two separately. Let's start by taking a look at finite life intangibles. For finite life intangibles, we say something that is not very seldom said in IFRS these days. And that is that the accounting is easy. What do I mean by that? Well, it really is easy. I mean, you take the cost on day one of the asset, and all it says is effectively amortize it over its useful life. Of course, like property, plant, and equipment, you do need to determine a residual value for that. So you're amortizing it down to the residual. But unlike PP&E, there's an assumption here. And the assumption here effectively is you can assume the residual to be 0. So the starting point we're saying is use a residual of 0. The only time we would not use a residual of 0 is either A, if somebody's committed to buying the asset from us at the end of the life. So I say I'm using your brand for 5 years, and somebody says, great, at the end of 5 years, they'll pay me $100,000 for it. Then I know the value. Well, then I'm going to amortize it down to a residual of 100,000. Or secondly, if there's an active market in that intangible. Well, we know we can scratch out that because, as I said, there really aren't any active markets that we use. Which means unless somebody has committed to buy an asset from you, you can assume a residual of 0. So this is really nice and easy, guys. Cost on day one. Straight line method generally for amortization down to 0. Nice and easy. Of course, like property, plant, and equipment, they do require you to do a couple of things on an annual basis to review. The first one says, of course, you'd have to, on an annual basis, review your residual value. Once again, you'd only do that if you're using the active market one or the third-party commitment. If you're assuming 0, which I believe most of you probably wouldn't practice anyhow, that becomes irrelevant. The other ones you'd have to do, probably the only one I see in practice, is the amortization period. That's where I have a brand, I think it's going to last 5 years. Suddenly I actually think it's doing better, it'll last 7, or it's doing worse, it'll last 3. So you'd adjust that amortization period. And the third one being you change your amortization method, but that's very unlikely. So the only one of these that really we see in practice working is where people potentially have to change the amortization period. Like anything else, these are changes in estimate, which means under IAS 8 you would account for this on a prospective basis every year. So as I said, the accounting for your finite life intangibles, really guys, very simple. Cost on day one, or fair value if you've got something like an exchange, down to a residual of 0 on a straight line basis. And the only thing you'd need to consider every year is, has the useful life changed? If it has, adjust that as a change in estimate in the year in which it happens. Nice, simple, and easy. Moving on then to the other ones, and the other ones are what we call indefinite life intangibles. Now, I think it's important to point out, and maybe I just need to highlight the language, especially for the non-English speakers out there. When I say indefinite, I'm not saying infinite. Now, there's a small difference between these, and that is that infinite means something will last forever. So infinite is it will never have an end. Indefinite just means that at the moment I cannot define a useful life. But what's important is it means at some point I believe I could. So we're not talking about infinite, we're talking about indefinite. How do we deal with these? Well, because we don't have a useful life, we don't do any amortization. We do annual impairment tests on these, which means effectively every year you have to do an impairment test on these. The most common indefinite life intangible asset is goodwill. As many of you will know, goodwill in the business combination is an intangible asset, but that is always deemed to be indefinite. So you can never have a finite life goodwill. So here we're saying if I went and bought, for example, the Apple brand, I would have to every year do an impairment test on that. Now that, guys, is a lot more work than the one for the finite life, which is why most people prefer finite life, because they can just amortize it straight. Whereas indefinite, you've got that annual impairment test to do every year. Building on from that, remember, I did say these aren't infinite, they're indefinite. What that means effectively is every year you need to then review the useful life. So if I went and bought Apple, I would every year have to say, okay, I do my impairment test. Do I now believe that there's a useful life? If the answer is no, I'd continue to do an impairment test for the following year. If I get to a stage where I go, actually, yes, now I do believe there's a life for it, once again, then I would start at that point doing amortization. So very importantly here, you need to be saying to yourselves, which way would that work? Do I think that there's now a useful life, in which case I move it to finite, or do I continue to do it as indefinite? So that effectively are the principles around doing your accounting around IAS 38. And I think it's quite important just to understand that there are some small differences. Remember, up front, you've got to be able to show effectively that that this does meet the definition, and we've got that whole identifiability criterion that has to be in there. There are 5 ways you can get the asset onto balance sheet. Some of those requiring fair value, some of those giving you an option, for example, government grants between a notional amount or full fair value, and some of those like where we've just got a simple acquisition where we're using cost. So it's a bit of a mixed bag in terms of how we get them onto balance sheet. Once they're on balance sheet, then of course it says you can do cost or revaluation, but as we pointed out, revaluation very unlikely to be used, which means you're most likely going to be going cost. Cost, of course, being easy. Cost on day one, amortize it down to effectively a residual value of 0, unless there's an active market or there's a commitment. Whereas indefinite life, as we said here, having to do an annual impairment test. Last thing I just wanted to point out to you on the intangible assets is remember that you still have impairment testing for the indefinites, but remember impairment testing also impacts on the finite life intangibles. Remember IAS 36 effectively saying that we've got the impairment methodology, and under that impairment methodology that if you have an indicator of impairment, even for your finite life intangibles, you would need to do an impairment test. So indefinite, you're following this methodology, you're doing it continually. For your finite lives, we say only have to do the impairment test there, like on fixed assets when there is an indicator. Very importantly, remember, every year you need to assess whether there are any indicators. So for example, they could be internal indicators, a company you bought the intangibles or the customer lists that you recognize aren't generating the returns you thought, they're behind budget, whatever it may be. There could be market factors, increases in interest rates, decreases in markets, macroeconomic factors. Anything that could give rise obviously indicates that you would need to do an impairment test. Once you know that you have to do the impairment test, as I mentioned, IAS 36 would kick in and you would follow that simple methodology there. So please do remember IAS 36 applies to your finite life intangibles when there's an indicator, and your infinite or your indefinite life intangibles obviously on an annual basis. So that, folks, in essence, is ICE 38 on intangible assets, and all I've done here is given you a summary of some of the issues that we've discussed there. I haven't gone into all the presentation and disclosure, but remember, of course, you will, much like with your property, plant and equipment, there's quite a bit of disclosure that needs to be given. Tables in terms of additions, amortizations, impairments, etc. For the current year and the prior year, so quite a bit of disclosure that needs to be given there. Remember, of course, that you would also need to disclose your key assumptions around things like your indefinite life intangibles, when they are, your amortization periods, etc. So those are the type of things you would need to be putting in. So that effectively, folks, is the accounting for ICE 38 intangible assets. I hope you got some value out of that. Right, folks, I'm just going to wait to see if there are any questions. If anybody wants to ask, do feel free to type those in and we can have a look at those. I do see that there's a couple that have come through. One was on business combinations, saying, can we use a cost-benefit exemption or try and use some sort of cost-benefit to get out of identifying intangibles? The answer is no. In terms of IFRS 3 and business combinations, you have to split out all the intangible assets in a business combination and recognize them under this standard. Cost-benefit exemption, remember, that doesn't really apply in big IFRS. In the IFRS for SME standard, yes, there is a cost-benefit exemption for business combinations where you can avoid doing this. But unfortunately, under big IFRS, no, you can't do this. Another question that came through I saw related to professional services, saying if you buy a professional services firm, would that mean that everything is sitting in goodwill? Generally, the answer to that would be, well, the majority of it would be. I mean, if I went out and bought an audit firm tomorrow, the majority of the audit firm is going to be its people. And as I mentioned earlier, you can't account for people. You can't control people. Therefore, you can never account for any person or any assembled workforce as an intangible. So in that situation, we would only effectively look at the brand or any customer lists or things like those as separate intangibles. But yes, the majority of it being the workforce would be left in goodwill, which means you have quite a big goodwill figure. Last one I saw coming through there also on goodwill, saying, will the ICE be moved back to amortization on goodwill? Very good question, and the answer is potentially. It has been discussed by the ISB where a lot of people are saying they would prefer to move back to amortization. Reason being that people are saying that the impairment test, annual impairment testing, is onerous, it's a lot of work, and given very few people see value in goodwill. As I mentioned, very few analysts and investors attribute any value to it. They're saying, can't we just move back to a stage of actually just writing it off over a period? I know that some people I've spoken to have said they would rather just write it off in 1 year, rather than just get rid of it. Given they don't see a huge amount of value in goodwill, can we not just move it to that stage? Right, folks, I'm going to leave it there. Thank you very much for attending. I hope you got some value from it. Remember, we have got some live sessions coming up. So there is a live session coming up in a couple of weeks' time. You can book for it through the IFRS application. Please do go ahead and do that. The live sessions, as I say, a lot more case study based. And I actually think we look at business combinations. So if you're not sure about business combination accounting, please do attend the live session. There'll be a lot more workshops. I'm going to be taking this one in Feb. Hope to see some of you guys on that live session. Other than that, thank you very much. Take care. And